None of us like worrying about our investments, but it's a lot easier to say, I don't want to worry about my investments than it is to be able to say, I do not worry about my investments. So in today's video, I want to share with you some data that I used to share with my clients when I was a retirement advisor before I retired myself. And Vanguard has a bunch of great information, and this is one of their reports. It's called What to Do When Markets Drop. Now, as I record this, the S&P 500 in 2025 has clawed back all of its losses. And as of a few hours ago, was actually positive for a year, a little bit less than 1% down. But the time to prepare for the next correction is when you're thinking calmly and when you don't feel the pressure of the market being down 15, 20% or more. So this report by Vanguard, What to Do When the Market Drops. The first thing I want to share with you is this chart going back to 1980 that just shows the long-term stock market history. And you can see, in general, things are going from lower left to upper right, which is a good thing, but there's these dips in there. And those are the dips that really worry us, right? I mean, you look at the 2000, at the end of the dot-com bubble burst, that was a huge correction. 2008, 2009, the market was down over 50%, the S&P 500, over 50% from top to bottom. And that is potentially a life-changing correction if you don't navigate it successfully, right? So that's what these drops look like. But let's look at Vanguard shares with us another view of that same chart that shows the amount of time and the scale of the positive gain versus the negative gain. And so you can see here, I'm slightly colorblind, but the gold, the brown, that is the dips. And you can see the dips. I mean, we all want the green. And most of us looking at this chart would say, I'm willing to go through the gold, the brown, in order to get that green, the blue, positive. And you can see the average bull market had stocks almost doubling, 96% average total return, and it had a length of over 1,000 days. In the average bear market, the total down of that market average was 30%. It was 282 days in average, and there were 12 bear market declines of 20% or more during this period of time. So when you look at it that way, you say, well, of course I'm willing to do that, right? But it's one thing to say you're willing to withstand that. Even look at the 2008, 2009. Now that's a big dip. As I said, it's down 50% there. You can see that. But looking at all the green surrounding it, many of us would say, oh, theoretically, I'm willing to withstand that. So how do we do it? That's the question. So first is information. And I'm going to continue to share more information. There's a great section of this Vanguard report that says, don't panic during market turmoil. Now, we're not in market turmoil now, but we could be in another month, another 6 months, another year. Vanguard goes on to say, investors who have overreacted to market events by moving to cash have seen their portfolios underperform the markets. Long periods spent out of the market make matters worse. Now, what I would say is often makes matters worse. It doesn't always, but they're going to share with us the stats. And before I share the stats, I do want to share, none of this is financial advice. I don't know your situation, but I want to give you some information. I want to give you some ammunition and some facts to help you stay the course when you need to the most. Okay, these are the return distributions of people that have said, okay, I'm scared of the stock market. I'm going to move 100% into cash, and then I'm going to move back. And so Vanguard did this analysis and said, if you do that during these periods where the market has gone down, if you stay 3 months in cash, you have almost a 75% likelihood of underperforming versus overperforming. Same thing if you stay in the market for 6 months. It's a little bit, the odds are a little bit more in your favor, but it's still 71% out of your favor. So not quite as bad as 3 months. But look at this, people that stayed 12 months in cash, 87% of the time, they underperform what they would have done if they just stayed the course. And why is that? Well, first off, most of us have balanced portfolios. And as Vanguard says here, balanced portfolios of stocks and bonds have proven resilient. The longer you hold a balanced portfolio, the more likely you are to experience positive performance. So let's look at this result. So the upper half of this, the blue, is what percent of the time have both stocks and bonds been down, right? So if you have a portfolio of stocks and bonds, the hope is when the stocks are down, the bonds are not. And this chart shows that the vast majority of the time, your bonds, one of the two are going to stay positive. So over a 1 month period, it shows us the percent of time that the market and the stock market and bonds have been negative, then 3 months. But importantly here, since 1976, investors have never encountered a 3-year span of losses in both stocks and in bonds. It doesn't mean there's not a 3-year negative period, but either the bonds have been positive or the stocks. But really, we're talking about the bonds because we have bonds in our portfolio to help us withstand the volatility of the stock market. I'm going to talk more about bonds here in a second, but first I want to go into a little more data as to why it's so dangerous to try to move into cash, to try to time the market. And for that, I want to go to a good report by Hartford Funds. The article is called "Timing the Market is Impossible." And one of the reasons is because some of the strongest days in the stock market happen right after some of the scariest days in the stock market. So you can see here the 50 best days over a 30-year period, 1995 to 2024. And 50% of the time, those best days occurred during the bear market. Then the next 28% of the time during the first 2 months of a bull market. So we weren't really sure we were out of that bear market yet. And then the 22% of the time happens after a bull market has been running for over 2 months. And so what's the result on somebody's financial results? So this is missing the market's best days has been costly. So if you look at that same period of time, 1995 to 2024, you can see if you'd stayed fully invested, that's the benchmark there. But if you miss just 10 of the best days over that 30-year period, so over 1,000 days, if you miss just 10 days out of 1,000, so what is that, 0.1%, 1/10 of 1%, you're going to get more than half less. You're going to get 54% less. If you miss the 20 best days, you're going to get 73% less. And if you miss 30 of the best days, you're going to get 83% less results. So what does this mean? What it means is have a portfolio, have an asset allocation that works for you. We want to have bonds, again, not financial advice, but bonds can help you navigate challenging times. They can also help avoid being a forced seller in a down market, because once we retire and we need to take money out of our savings in order to fund our living expenses, we can take that out of our bonds instead of our stocks and avoid being a forced seller in a down market. If you like this video, the YouTube algorithm says this is the next video of mine you should watch. Thanks for watching this one. Bye-bye.